Hi, everyone. This is Marty Becker, owner of Atlas Financial Strategies and your host for episode number 23 of the Atlas Annuity podcast. In today's episode, we're going to be looking at a case study that I've recently done, and we'll just refer to this as the Atlas Annuity strategy versus the dinner seminar annuity. So what happens quite often actually is people will reach out to me to get a recommendation or a second opinion on an annuity that they were, quote, pitched at a dinner seminar. Now, I don't have anything against dinner seminars or the advisors that put them on. What I do have a problem with is that you have a room full of people with very different scenarios and financial situations, and they're all being pitched the exact same product, even though there's no way that it's appropriate for all of them. So the couple that we're going to look at today reached out to me are 63 and 65 years old. The husband's going to work for about another 3 years. The wife is already retired, collecting a pension. At his retirement, they'll have about $6,200 a month between the Social Security and her pension. They got about 1.5 million in assets between IRAs and Roths and non-qualified money, and they're looking for about $8,800 spendable per month. So that's after tax. So probably when it's all said and done, after income taxes and Medicare costs and things like that, probably looking at close to anywhere from $9,500 to $10,000 a month that they'll actually need coming through the door. Now, this particular client was pitched a popular annuity at a dinner seminar for about $450,000 and was buying into the hype and some really unrealistic growth projections on it. And what we're going to do is we're going to look at several different scenarios. Number one being what happens if they just keep doing what they're doing without any annuity? What would happen if they implement the dinner seminar annuity? Then we'll also look at the Atlas annuity strategy, and we'll look at both of those in a worst case scenario. So looking at the first scenario, which is if they just keep doing what they're doing with all of their current allocations, the four key indicators of the health of their retirement plan are the investment net worth, the reliability of income, the withdrawal rates, and discretionary liquid assets. Now you can see here, if they just keep doing what they're doing, and this is with a level return on their assets of 7% in their stocks and 3% in their fixed assets, they'll have money till about age 93. And again, that's if everything just keeps going steady and perfect, which we know is not going to happen. So it is concerning that they're going to run out of money in their early 90s, and they have no discretionary liquid assets. Now, if you don't know what I mean by that, go back and listen to episode 22, where I get into great detail on what that means, but kind of a high-level explanation is discretionary liquid assets means how much can you actually pull out of your investment portfolio in retirement that isn't already allocated to produce the income that you need. So what this is showing, doing what they're doing right now, they have to keep 100% of all of their assets invested forever. And they just can't go in there and grab $50,000 or $100,000 and go buy a boat. They don't have that option doing what they're doing. And the other thing we want to look at in this specific scenario is the reliability of income. And what that means is how much of their income need, so that $8,800 per month after taxes, how much of that is actually provided on a guaranteed basis. Doing what they're doing with his Social Security and her pension, only about 60% of their income is based on guarantees. So that means they have to make up the rest of the gap by pulling from the portfolio, which is why they're running out of net worth and why they have no discretionary liquid assets. So in these comparisons that we're going to look at, we're mainly going to look at the investment net worth that they have and the discretionary liquid assets. And I did that just for, if you're watching this on YouTube, that I can make these charts a little bit bigger for the things that really have the most importance to them. Just to let you know, the reliability of income goes up to 80% in both the dinner seminar annuity and the Atlas strategy annuity. So like I mentioned before, this particular annuity that they were told about at the dinner seminar, it has a lot of hype around it because it has a big bonus. It has a long-term care benefit rider attached in it, and it also has the opportunity for increasing income. Now, when they were shown this originally, they were being shown some extremely unrealistic growth rates. So I had to be the bad guy and bring them back down to reality and say, in annuities like this particular one that you were shown, we need to be super conservative because we're counting on this for income. So we don't want unrealistic projections. So we're going to stick with about a 3.5% growth rate just to be on the safe side. So with those estimations, you can see, even using the dinner seminar annuity, their outcome is drastically better. Their investment net worth dips down over time, okay, but eventually it gets back to basically where they started in retirement at about $1.5 million. And the discretionary liquid assets, so free money available just to pull out for luxuries or emergencies, that improved as well. However, they really don't have any discretionary liquid assets with the dinner seminar annuity until around 78 years old. Now, most people that are in their late 70s, early 80s, they're actually starting to slow down at that point. So they really don't need to go pull $100,000 out to buy a ski boat. Most people want to do that early in their retirement when they have the energy and the will to do it. Not that they can't do it later in life, but just most people are slowing down at that age. So now let's look at the Atlas Annuity strategy recommendation, which is it's a plain Jane fixed indexed annuity with a guaranteed income rider. Okay, so it's very predictable. We know what we're going to get out of it. Their net worth ended up about the same long term from when they first retired, which was pretty much the same with the dinner seminar annuity. But look at what happened to their discretionary liquid assets. The day this gentleman walks out the door for his retirement, they have almost $300,000 in discretionary liquid assets that they can tap into if they want to go do some luxury things above and beyond their income needs. So if they want to go pull $100,000 out to buy the ski boat, they could do it. And not only that, the discretionary liquid assets never drop below $100,000 the rest of their lives. So they always have free liquidity. Now, one thing I always do with every single client is we want to look at a negative sequence of returns when we're income planning, meaning what is our worst case scenario here? So we can actually stress test these models to see what would happen if we go into a market like in the early 2000s, where the S&P 500 lost about 50% of its value in a 3-year period. And using the dinner seminar annuity, they still fared better than doing what they're doing, which is the red line if you're watching this on YouTube. Implementing the dinner seminar annuity into their retirement plan, which is the green line, they still ran out of net worth around their mid-90s. Now, again, they would still have the income from Social Security, pensions, and that annuity, but they don't have any discretionary liquid assets, which is not uncommon when we look at these models and we look at the worst of the worst case scenario. However, one thing to point out about this is if the growth of the annuity, the growth of the income from the annuity is based on market index performance, and we go into a down market, meaning they're not getting growth in the income, how will that negatively affect them long term? And this is a reason why I only use an average 3.5% growth rate on these things, because if you take some big hits and you have no growth in that annuity in the early years, it can drastically alter the outcome from what the illustrations are showing you. So this is why you want to take those illustrations with a grain of salt that show you the increasing income. So obviously this is not ideal, but it's definitely a better outcome of doing what they're doing now. Okay, so now let's look at how the Atlas annuity strategy held up in this negative sequence of returns or worst case scenario. And as you can see, even with some of the worst returns in the history of the stock market, implementing the Atlas annuity strategy, annuity recommendation, they would still have about $200,000 at the age 100. And again, that's with some of the worst returns we've ever seen in the history of the stock market. Now, of course, they don't have any discretionary liquid assets with the Atlas strategy either. But again, that's not uncommon in these really bad marketplaces. Okay. And remember, they didn't have discretionary liquid assets at all before. It wasn't until we started implementing some annuities in there that it actually freed up some money that they could go spend above and beyond the income need. $200,000 difference by age 100. This is the difference between a guaranteed annuity with an income that we can count on and we know is going to be there versus some of these hyped up annuities that show you these really great projections that we don't know what they're going to do because none of the growth is guaranteed. So this is the difference between knowing exactly what we're going to get and everything else. Because at the end of the day, everything else is just speculation, whether it's growth from an annuity or growth in the stock market. It's all speculation. So we want to lay the foundation of guaranteed income in addition to the Social Security and any pensions if you're lucky enough to have one, like this couple did. Okay, so one last scenario that I want to take a look at here is, what if the opposite happens? Because one thing I'm always very cautious of is, number one, I don't want to hurt my clients by putting them into an annuity, which is why we look at a worst case scenario to make sure they're always going to have net worth left. But then I also don't want to cost them opportunity if we go into a really good market. So again, as we stress test these models, we can look at a positive sequence of returns going back to the year 1995, where the S&P 500 had 5 huge years in a row. And as you can see, even if the market does very well, they didn't lose anything by putting that portion of the money into the annuity. In fact, it's a dramatically different outcome long term. It says here, if we go into that same sequence of returns, that their net worth gets up to $8 million, which is insane. Okay, I'm never going to promise people that because that's totally out of our control. But what we're showing here is they didn't lose any opportunity in the market by putting the money into the Atlas annuity strategy. Because what's really happening here is the income from the annuity is carrying such a large weight of the income need, they're able to leave more money in the stock market to be invested for the long-term gains. And again, this is me saying you can't be all annuity and you can't be all stocks. There's a sweet spot in there, and we found it with this couple. So they still have huge opportunity for market growth. In fact, it turned out way better, as I mentioned, by putting the annuity in there because they can continue to take that heavier risk in the market, knowing that such a large portion of their income is guaranteed. And then, of course, the discretionary liquid assets are off the chart as well. So this is the difference of planning like most advisors do on just level returns versus let's look at the worst case scenario and the best case scenario, because this is going to be a dynamic process as your years of retirement go on. Okay, so just a quick recap of what we looked at in this case study of the dinner seminar annuity versus the Atlas annuity strategy. Current scenario of this couple, 63 and 65 years old. The husband's going to retire in about 3 years. Right now, their portfolio is allocated between 70% stocks and 30% fixed assets. If they keep doing what they're doing with level returns, they're going to run out of money around age 95. And they never have discretionary liquid assets for emergencies or luxury purchases. If they implement the dinner seminar annuity with level returns, the outcome is better. In fact, their net worth ends up about the same as when they retired, but they don't have any discretionary liquid assets until around the age of 78. But the worst case scenario with a negative sequence of returns using the dinner seminar is they still run out of money, but not until about age 96, 97, 98. And still no discretionary liquid assets. So it's an improvement from what they're doing. And if we look at the Atlas annuity strategy, again, just with level simplistic returns, their net worth stays about the same as when they walked out the door from their jobs, but their discretionary liquid assets shoot up to $300,000 on day one of retirement, and they never drop below $100,000. But again, we always want to look at worst case scenario, which still shows them having $200,000 even if they live to age 100, above and beyond the Social Security, the pensions, and the income from the annuity. Now, again, of course, no discretionary liquid assets, that's not uncommon, but we also looked at what would happen if the market went crazy in a good way. So that's what we do. We want to verify what's the worst case scenario, but also we want to verify that we're not going to cost you any future opportunities of what you could have had if your money was somewhere else. So that's going to wrap up episode 23 of this particular case study, dinner seminar annuity versus Atlas annuity strategy. If you liked what you saw, please like, subscribe. That really helps us get this information out there on these different podcast platforms. Now, if you ever want to see what an Atlas annuity strategy would look like for your specific situation, you can go to atlasannuity.com to book a short phone call so I can get your questions answered for you. And also at that same address, atlasannuity.com, you can navigate to all of my different resources to help continue the financial education to make sure that this is a path you would even want to start to go down. And again, short phone call, no obligations. I'm not going to beat you up. I'm not going to chase you around. It's really just to get your questions answered and to see, from my perspective, if this would even be a good fit for you to begin with. So this is episode number 23. I hope you found it helpful. Again, Marty Becker, wishing you all the best in your financial education, and we will see you in the next episode.